calculator with you. We are doing some important numerical based on Unit 7 and Unit 8. Right? Let's start. Let's start with the first case study that we have. Right? This case study exactly I have taken from the December examination. Right? So this is a set of 5 questions, and let me explain what the question is all about. So here you can see, आप यहाँ पे देख सकते हैं, this is the data of financial data of firm A, firm B and firm C for the year 21 and 22. So let me highlight the data, right? And as you can see, just wait a minute. Yeah. Okay, now it is okay. Now you can see the first particular is sales. Let me zoom a little bit so that the picture become clearly visible to you. I hope it is visible now. So you can say the sales is given, all the data have been given in lakh. Sales is 50 lakh, 60 lakh and 80 lakh. Variable cost, EBITDA. You know what is EBITDA? Earning before interest, tax and depreciation. That is called EBITDA. That is given, right? 15 lakh, 17 lakh and 20 lakh. And then, then we have interest cost, which is a part of fixed, right? And then depreciation and amortization, which is the fixed cost, right? And then we have the tax. So these data have been given, right? Such type of case studies are asked in the examination. Good evening everyone. So I hope everyone listening to my voice, right? So this is the financial data of the firm A, B and C. Now let's see this question. I will मैं आपको दोबारा इस ये slide provide कर दूंगा. I will again provide you the slide. Now let's see the first question. Based on the above data, what is DFL of firm A? You have to calculate the degree of financial leverage of the firm A. This is a conceptual session. We will try to understand the concept using solving numerical. हम लोग अपने concept clear करेंगे numerical के माध्यम से, right? That is what this session is all about. So you have been asked to calculate DFL. What is DFL? Degree of financial leverage of firm A. Options are 1, 1.33, 1.5 and none of the above. Let me again come back to this slide. Right? Everything we will do on this slide. Now friends, you know what is the meaning of DFL? Right? You know what is the meaning of DFL? DFL पता है आपको क्या होता है? Let me explain a little bit about this DFL. So DFL means degree of financial leverage. It tells us how much a company profit before tax. There's something called EBT, that is called earning before tax, right? Or we call it profit before the tax. So it tells us how much EBT change in the response to change in EBIT, right? How much EBT change in the response to the change in EBIT. So the formula for DFL is, what is the formula for DFL? Right? What is the formula for DFL? The formula for DFL is very simple. That is EBIT, earning before interest and tax upon EBT. Right? This is the formula for calculating the DFL. What is EBIT? EBIT means earning before interest and tax. What is EBT? EBT means earning before tax. Now friends, how to calculate this EBIT and EBT? Right? Let us calculate it step by step. I am telling you the exact procedure how to go about calculating this EBIT and EBT, right? So what I will do, I will draw a pie chart. This is a technique which you can use to easily calculate this EBIT and EBT. Let me explain, right? What you do, suppose you draw a pie chart like this. Fine. So what is the total sales? Look at the firm A. Look at the data of the firm A, right? This is a technique which I use to solve such kind of problem. And if you use it also, it will be very easy. ये जो टेक्निक है, इसको आप यदि यूज करेंगे तो आसानी से आप EBIT और EBT निकाल सकते हैं. Let me explain. So what is the total sale? Total sale is 50 lakh. So I will write here 50 lakh. Okay. Now, out of this total sale, some portion of the total sale is our variable cost. So let's say this portion. I'm writing in red color. So this portion is our variable cost. Variable cost is how much? It is 30 lakh. Now can you tell me what is the contribution? Right? What is the contribution? So contribution is this portion, right? This portion which I am highlighting by the red color, which I have highlighting by the red color. This is called contribution, right? So how much will be the contribution? Our contribution will be how much? Let me use the different color, right? Let me use green color. So our contribution will be 20 lakh. How did we get the contribution? So contribution is nothing but sales minus variable cost, right? So sales is 50 lakh and variable cost is 30 lakh. So 50 minus 30 is 20 lakh. So contribution is how much? 20 lakh. Now let me ask you a question. If suppose the company increase its variable cost, will contribution go up or go down? Please answer. यदि मान लीजिए कि कंपनी अपना वेरिएबल कॉस्ट बढ़ा देती है तो कंट्रीब्यूशन बढ़ेगा या घटेगा? Just waiting for your response. Suppose the company increase its variable cost, will the contribution go up or go down? Suppose variable cost increase, instead of 30 lakh it become 40 lakh. What will happen to the contribution? Will it go up or will it go down? Now, this is the first step. We have to calculate the variable cost and then the contribution, right? So obviously it will go down, right? The contribution will go down because, yes, obviously it will go down because, more cost means less margin, right? If the cost is more, it means less margin. Now, after that, we have calculated the contribution, which is 20 lakh. Let me erase this particular point, right? So basically this particular half, so let me draw another half here, right? So I'm just drawing it half here. I hope it is visible to you, right? So this portion I am representing. This portion, right? So it consists of two things. What is given here? EBITDA, right? EBITDA is how much? Let me erase it. Just wait a minute. So now you can see EBITDA, earning before interest, tax, and depreciation of the company is how much? 15 lakh, right? What is the earning before interest, tax, and depreciation of firm A? It is how much? It is 15 lakh, as you can see, right? So, and what is the depreciation? So first of all, let me again draw it. Just wait a minute. Let me again draw it. So this was the pie chart which we draw, and this was the contribution, right? So this was the contribution portion. Some portion of the contribution, right, is the profit, and the rest portion is the fixed cost, right? So as you can see here, what is our contribution? Contribution, just now we got 20 lakh, right? And what is our EBITDA? Earning before interest, tax, and depreciation is 15 lakh, and how much is the depreciation? Is 30 lakh. So you can see earning before interest, tax, and depreciation is 15 lakh and depreciation is 3 lakh. So just subtract. What we will do, how to calculate EBIT? Earning before interest and tax is equal to earning before interest, tax, and depreciation minus depreciation, right? So if we subtract depreciation from EBITDA, we will get what? We will get EBT. We will get what? EBT, right? So how much is the EBT? EBT is how much? 12 lakh. Is it clear? EBITDA minus depreciation. If you subtract, what is amortization? What is the meaning of amortization? Please tell me. Yes, obviously. Amortization is the depreciation in terms of intangible asset. देखिए asset दो तरह के होता है. Asset are of two type, tangible and intangible. For tangible asset we call depreciation, and for intangible asset, like let me give you one example, like patent, right? For patent, depreciation is called amortization, right? So we have to calculate what? We have to calculate EBIT, which is earning before interest, tax. So what we will do, from EBITDA we will subtract depreciation, we will get EBIT, right? How much it is? 12 lakh, right? And then we have to calculate EBT, which is earning before tax, right? How to calculate EBT? Please tell me how to calculate EBT. Can you calculate EBT for me? So it is quite easy. From EBIT, if you subtract the interest part, if you subtract the tax part, interest part, right? How much is the interest? You can see it is 4 lakh. This is the part of fixed. So what will be the EBT? Can I get some responses? Please tell me what is the EBT? Very easy question it is. So from EBIT, if you subtract the interest part, you will get what? EBT, right? How much is the EBT? Please tell me. So it is nothing but EBIT minus interest. So EBIT we have just calculated 12 lakh. And how much is the interest? Interest is 4 lakh. So 12 minus 4 is how much? 8 lakh, right? So now we got EBIT, now we got EBT. What is asked in the question? To calculate the DFL, that is the degree of financial leverage. What is the formula? EBIT upon EBT, right? EBIT upon EBT. So what is the answer? 12 upon 8. So what it will be? 1.5, right? So the correct answer to this question is option number C, 1.5, right? So this is the step you have to follow to solve such type of problem. Yes, option B, yes, obviously EBT is 8 lakh, right? And DFL is what? DFL का formula क्या होता है? DFL is EBIT upon EBT. So 12 upon 8. This is equal to how much? 1.5. So how to go about solving such type of problem? Let me explain. See. So what is the meaning of this 1.5? Is 1.5 का क्या meaning है? Do you understand the meaning of this 1.5? Let me explain. This 1.5 means that, right, if profit change by 1%, right? See, this 1.5 means that if operating profit change by 1%, right, then profit before tax, PBT, change by 1.5%. So this indicate, if DFL is higher, it means financial risk is higher, right? If DFL is higher, it means financial risk is higher. So what we did, you see, first of all, we have EBITDA, which means interest before earning before interest, tax, and depreciation and amortization. You must know the full form, right? Earning before interest, tax, depreciation, and amortization. From EBITDA, right? We subtracted what? We subtracted the depreciation. We get what? We get EBIT. And from EBIT, we subtract the interest. We get what? EBT. And now we have EBIT. Now we have EBT. We just find their ratio, and then we will get the the DFL, right? Is it clear? I hope it is clear. Please let me know it is clear or not in the chat box. One more question I want to ask you, that suppose if the country has, if the company has no interest cost, suppose no interest cost is there. Suppose if the company has no interest cost, what will be DFL? DFL will be what? Option A, 1. Option B, greater than 1. Option C, less than 1. What do you think? Suppose no interest cost is there, what will be the degree of financial leverage? Just waiting for your response. Is it 1? Option A, 1. Option B, greater than 1. Option C, less than 1. In this case, you can see interest cost is there. How much is the interest cost? Interest cost is 4 lakh. Suppose no interest cost is there. How much will be the DFL? How much will be the degree of financial leverage? Please let me know. Waiting for your response. Just make this session interactive. I want your response, because let me see whether you understand DFL clearly or not. DFL means what? EBIT upon EBT. Suppose no interest cost is there. What will be the DFL? That is what I am asking. DFL कितना होगा यदि interest cost नहीं है, interest cost 0 है तो, right? I am not getting any response from your side. Yes, very good. Option A, 1. Very good, right? Yes, it will be 1. Option A is the correct answer. It will be 1. Why it will be 1? Because if there is no interest, then what will happen? EBIT and EBT will become same, right? If there is no interest, then what will happen? The EBIT will be equal to EBT, right? And the ratio will become equal to 1, right? So this is the point. Now let's see the next question. Question number 2. Among the 3 firms, which one has the highest DFL, right? Which one has the highest DFL? Firm A, Firm B, Firm C. So Firm A, we have just calculated DFL, it is 1.5. Can you calculate the same for Firm B? Please calculate the same for Firm B. Just write in the chat box how much you are getting for Firm B. Question is asking which is having the highest DFL. Please calculate for Firm B. And let me know in the chat box what is DFL for Firm B. Because once you calculate the DFL for each firm, then only you can say that this one is having the higher DFL, higher degree of financial leverage, right? So what is the DFL for Firm B? Please calculate. So let me explain. For Firm B, if we calculate the DFL, right? So DFL, it is EBIT upon EBT, right? And so for Firm A, you can see we have just calculated 1.5. If we calculate the same for Firm B, EBITDA 17 lakh, and from this EBITDA we subtract the depreciation, so we get EBIT. EBIT is how much? 14 lakh, right? And from this we subtract the interest, so we get EBT, which is how much? 10 lakh. So for Firm B is how much you are getting? Tell me. EBITDA minus which is our 17 lakh minus depreciation, which is 3 lakh, 14 lakh upon EBT, which is EBT. Further we subtract this interest cost, which is 4 lakh, right? So how much you are getting? It is 1.4. Are you getting the same 1.4? Please let me know. Yes, 1.4. Very good. What about the Firm C? For Firm C, EBITDA is 20 lakh, and depreciation is 4 lakh. So 20 minus 4 is 16 lakh. 16 lakh is your EBIT. And what is EBT? So EBT is, right, for Firm C, 16 lakh minus 6 lakh, which is the 10 lakh. For Firm C, it is 1.6, right? So for Firm A, we have got how much? 1.5. So for Firm A, it is 1.5. For Firm B, it is 1.4. And for Firm C, it is 1.6. Now, can you tell me which one is having the highest? Yes. So option number C is the correct answer. Firm C is having the highest, right? So 1.6 is the highest, right? So that is why the answer to this question will be option number C. Firm C is having the highest degree of DFL. right? Now let's calculate what is the DOL of the firm A, right? What is the DOL? So the question is, what is the degree of operating leverage of the firm A, right? So let me come back to this question. So here it is asking you to calculate what is the degree of operating leverage for the firm A. Till now we were discussing about the DFL, that is degree of financial leverage. Now it is asking us to calculate the DOL, that is degree of operating leverage. So do you know the formula for DOL? Let me explain. Let me explain what this DOL is all about, right? So DOL tells us if the sales increase by 1%, how much will be operating profit increase. So it tells us that if sales increase by 1%, suppose sales increase by 1%, what will happen to our EBIT? How much our EBIT will increase? In other words, it shows us how much a business benefit or suffer from the change in sale, right? So what is the formula for DOL? So you don't need to remember in the derivation part. You just need to remember the formula. That's it. You know the formula for DOL? The formula for DOL is contribution upon EBIT. Contribution upon EBIT. Remember this formula, right? Contribution upon EBIT, right? Yes. So you need to remember the formula of DOL, that is contribution in the numerator and EBIT in the denominator. Now the question is asking you to calculate the DOL of firm A. Now can you tell me what is the contribution of firm A? Just now we have calculated the contribution from the sale. We have subtracted the variable cost. So contribution from firm A is how much? C is how much? 20 lakh. We are talking about the firm A, right? हम लोग firm A की बात कर रहे हैं, right? So contribution upon EBIT, that is what is DOL, right? That is what is DOL. So now basically it shows the impact of sales on operating profit, right? Now let's calculate the DOL. What is contribution for firm A? It is 20 lakh. I am waiting for your response. And what is EBIT for firm A? Please answer. What is EBIT for firm A? So EBIT, we have just calculated the EBIT for firm A. It is how much? So EBITDA, which is 15 lakh, minus depreciation, which is 13 lakh. So 15 minus 13. If you have any doubt, please let me know. Right? I am here to clear your doubt. यदि आपको कहीं भी कोई दिक्कत है कुछ समझने में तो प्लीज मुझे बताइए कमेंट चैट बॉक्स में, मैं उसको दोबारा बताऊंगा. जस्ट नाउ वी हैव कैलकुलेटेड द EBIT, right? So EBIT is how much? EBITDA minus depreciation. So it is how much? 12 lakh. So now what you have to do? You have to put contribution in the numerator. What is contribution? Contribution is 20. And what is our EBIT? It is 12. So 20 upon 12, which will be how much? Nearly about 1.67, right? So let me come back to this particular question, right? So option number D is the correct answer. 1.67 is the correct answer. Is it clear? How did we get? Please write clear in the chat box if this concept is clear to you, right? So one more question I want to ask you, that if company has, suppose if company has no fixed operating cost, if company has no fixed operating cost, suppose company has no fixed operating cost, right? What will be DOL? What will be DOL? Option A 1, option B 0, option C 2, option D can't say. What do you think? Suppose a company has no fixed operating cost, what will be DOL? Option A 1. Yes, very good. It is clear. Now please answer this. Suppose a company has no fixed operating cost, what will be the DOL? 1, 0, 2, or can't say. So basically, let me explain this DOL in clear term. So whenever I draw this particular pie chart, just wait a minute. Let me draw it more clearly. See, whenever I draw this particular pie chart, right? So this portion I am referring to, this portion, it consists of two things. This is the variable cost portion. This is the sales portion. It consists of two things. One is the fixed cost, and other is the profit, or we call it EBT, or we call it EBIT, right? So some portion is fixed cost, some portion is EBIT. So whenever I say DOL, so and this entire thing is called contribution. This entire thing is called contribution. So if we zoom into it, right? So let me draw it further. If we zoom into it, so this entire thing is what? Contribution, and some portion of this is what? EBIT, and some portion of this is what? The some portion of this particular portion is your fixed cost. Now what I am telling you, that this, and what is DOL? DOL is the ratio of contribution upon EBIT. That means numerator we put this much and denominator will put this much. So this ratio is called, this ratio is called DOL, degree of operating leverage. Now what I'm asking you, that if fixed cost is 0, tell me, if this fixed cost will become 0, what will happen? This entire thing will become EBIT, right? This entire thing will become EBIT, and that is what our contribution is. So contribution will be equal to EBIT, so our DUL will be equal to 1. So the correct answer to this question is option number A, that is 1, right? Is it clear or not? Please let me know, because you know why I'm telling you graph, because using graph you can remember it. Sometime what happen, you will get confusion that what is whether for dual in dual whether EBIT in numerator or contribution in numerator. So using graph, I'm giving you graph, I'm giving you pie chart to make it clear. Very good, right? So what will happen if there is no if there is no operating cost, if there is no fixed cost, what will happen? The entire EBIT will be equal to contribution, and that make this ratio equal to 1, right? So using graph is the most perfect way. You did not remember any formula, just remember the graph, right? And you can solve any kind of question based on DFL or DOL. This case study exactly was asked in the examination, right? So just now I've told you how to find the DOL. The answer to this question is 1. So the DOL shows the impact of sale on the operating profit, right? And you know, the more fixed cost, if the fixed cost is more, if fixed cost is more, right, it means DOL will be higher, right? And it will be more risk plus more reward, right? Now that is the point. Now let's come back to this question. Among the three firms, which one has the highest DOL? Now let's come back to this question. Which is having the highest DOL, right? Now please do the calculate DOL for rest other, for B or C. So for A we have just calculated, it is 1.67. Please calculate DOL for B and C. Let me calculate it. What is DOL for firm B? Right. What is DOL for firm B? Let me do the calculation here. So what is DOL for firm B? So you can see sales is 60 lakh, variable cost is 36 lakh. So contribution will be how much? 60 minus 36 will be equal to 24 lakh. So contribution, we are talking about firm B. For firm B, contribution is 24 lakh, and you know the EBIT for firm B is how much? So EBITD is 70 lakh and depreciation is 13 lakh. So it is 14 lakh. And now if we want to calculate DOL, which is contribution upon EBIT, which is 24 upon 14, how much you are getting? Please let me know how much you are getting. 24 upon 14, right? Yes, very good. Now please tell me what is 24 upon 14, how much you are getting. Similarly, if you calculate for C, contribution is how much? Sales minus variable cost, so it is 32 lakh. Contribution is 32 lakh for company C, and EBIT is how much? EBIT is, you know, EBITDA minus depreciation, so 20 lakh minus 4 lakh, which is 16 lakh, right? So DOL for firm C is how much? 32 lakh upon 16 lakh, which is equal to 2, right? For firm C I am getting 2. What about firm B? It is nothing but 12 upon 7, which is nothing but 1.7 something, 1.7. Are you getting the same for DOL? Yes, 1.71. Very good. For company B it is 1.71, for company C it is 2, and for company A we have just calculated it is 1.67. So which one is having the highest DOL? Tell me which one is having the highest DOL? It is firm C, right? It is firm C. So what is the correct answer to this question? The correct answer to this question is firm C is having the highest DOL, right? I hope it is clear now, right? So firm C is having the highest DOL. Now let's see the last question. What is the DCL of the firm A? That is called degree of combined leverage, right? This is the third last question, right? So what is the DCL? What is the DCL of the firm A, right? So 2, 2.5, 2.75, and option D, none of these. What do you think about the DCL? Let me come back to this particular question, right? You know what is degree of combined leverage? How to find the degree of combined leverage? So simply what you do, the formula is very simple, right? We just have calculated DUL, which is 1.67, and we have also calculated the DFL, which I think it was again 1.67. What was the DFL? So EBIT upon EBT. So EBIT we have calculated how much? 15 minus 3, which is 12, and EBT we have calculated, you know, that is divided by 4. Yeah, that is, you know, 8. So it was 1.5, I think. So this was DFL. For firm A, DFL is 1.5 and DUL is 1.67, and you have to calculate DCL. DCL is called degree of combined leverage. You know, DCL is a product of DFL and DUL. Remember it. If you find the product of DFL and DOL, you will get DCL, right? Very good. So multiply DFL and DOL. So please tell me what is the answer? What will be the DCL of firm A? Please tell me. So DCL is the product of DFL and DOL. So 1.67 multiplied by 1.5. How much you are getting? Please let me know. right? So let me show you the option. Let me show you the option. So these are the option we have: 2.00, 2.50, 2.75, none of the above, right? 2.505, very good. 2.505. So option number B is the correct answer, right? So we have just now learned three things, right? First of all, DOL. So degree of operating leverage. It tells us how EBIT react to the change in sale, right? Then we talk about DFL, degree of financial leverage. So how earning before tax react to the change in EBIT, right? And when we multiply both of them, we get DCL, right? So we show the total effect, right? So I hope the concept is clear. We have discussed 5 questions and we know how to calculate them. Now let's see the second question, right? Let's come to this particular question. Let's see what it is all about. Very important question it is, right? A company named ABC Limited, right? So basically what is happening here, a company named ABC Limited, right, took a loan of 50 crore. It has took a loan of 50 crore, right, from banks. But unfortunately, due to market slowdown and internal problem, right, basically it could not repay. It failed to repay. Now listen carefully. During restructuring, during restructuring, 10 crore of the loan, you can see 10 crore of the loan was converted into equity share of the company. So 10 crore of the loan was converted into equity of the company. The bank even got a seat on the company board. You can see the bank got a seat on the company board, right? But could not sell those share due to poor marketability. Now the question is, now the question is, based on the question, which of the following statement is most accurate? Option A, there was a pre-planned conversion executed as per the original loan agreement. Option B, the bank willingly converted loan into equity to earn higher return from the rising share price. Option C, this is a restructuring measure where loan was converted into equity due to repayment stress. Option D, the conversion gave the bank significant profit through dividend and capital appreciation. Right. So what do you think? Which statement is more accurate? Right. Yes. So which statement do you think is more accurate here? So let me explain like a story. You can understand it, right? See, imagine you gave your friend rupees 50,000. Suppose you gave your friend rupees 50,000 as a loan, but your friend lost his job and can't repay. You decide, okay, instead of cash, give me 10% ownership in your startup. You hope the startup will grow someday. That is exactly what is happening here. Bank converted part of the loan to the company's share, hoping for future recovery. Right. So, do you think that converting loan into equity is a safe move for the bank? Yes or no? Right. Do you think that converting loans, basically what bank have done that they have converted loan into equity. So, do you think that converting loan into equity is safe move for the bank? Right. Yes or no? Is it safe for the bank? What do you think? Obviously it is not safe, right? The answer is no, because it is risky, because bank are not a stock market investor, right? They prefer a steady repayment, right? So what do you think is the correct answer here? Which is the most appropriate, most accurate? So option number A suggests that there is a pre-planned there was a pre-planned conversion as per the original loan agreement. No, there was nothing like that. Basically it was a restructuring decision, right? And what about option B? The bank willingly converted loan into equity to earn higher return. No, this is also not correct, because it sounds good, but not the case. The bank did not expect profit. It was more of the damage control move. Option C suggests that the conversion was a process of restructuring. Yes, this is the correct answer. Right. This conversion of loan into equity was done for restructuring. Right. Option C is the correct answer. Right. And option D, the conversion gave the bank significant profit through dividend. That is also not wrong. That is also incorrect, because the share did not sell well. Clearly written, na, the valuation post conversion, right, but unable to sell the share. Right. It is clearly written that bank was not able to sell the share because of poor marketability. So bank got zero return. Right. So they got only a seat on the board. That is why option C is the correct answer to this question. Right. So what we learned from this question, is that loan to equity conversion is a restructuring tool. Remember, this is a kind of restructuring tool, not a profit making strategy. Right. And bank use this tool when borrower can't repay. It gives some kind of control, but also exposes them to market risk. Now let's see the second one. Let's see the second question. I hope the concept is clear. Converting loan into equity, right? What is the point? Now let's see this particular question. What is happening here? A company named XYZ Infrastructure Limited, right? It takes a 100 crore loan. It takes a 100 crore term loan to build a power plant. They want to build a power plant. That's why they took a 100 crore term loan, right? It was a huge project. Now the plant will take 4 year. The plant will take 4 year to build and will only start earning money after the year five, from year five, right? So the bank say, all right, we will give you 4 year moratorium. We will give you 4 year moratorium on the principal repayment, right? You will only pay interest during construction, right? But then XYZ bank come and say, we don't even have cash to pay interest right now. Can you also give us break on that? So question is, what do you think a moratorium means? Which of the following best explain the concept of moratorium? Option A, moratorium refers to complete waiver of both principal and interest. Option B, it is default remedy applied when a borrower is unable to repay on time. Option C, it is pre-agreed period where principal repayment is defined deferred to match the cash flow timeline. And option D, it allows borrower to delay repayment indefinitely until profitability is achieved. So what is the meaning of moratorium? That is what is asked here. What do you think is moratorium? Right. You can think of it like this way. Suppose you took a loan from your friend to open a restaurant. It will take 2 years to set up before you start earning. So would it make sense if your friend start asking for monthly repayment from the day one? Obviously no. So you tell your friend, give me 2 years, let me build, let me earn, and then I will start repaying you. So that 2 year break, that is called moratorium. Now what do you think? What is the correct option to this question? Is it A? Is it B? What do you think about option A? Right? Moratorium refers to complete waiver of principal and interest. What do you think? So, what about option A? Do you think option A is correct? See, here we are talking about, here we are talking about infrastructure project. See, option A is saying complete waiver of principal and interest. That is called, write off. That is called write off, right? The option B is saying remedy after a default. So this is called, this is called, this is no, this is incorrect because moratorium is pre-planned. It is not punishment, right? It is a grace period. Option C is saying it is a principal repayment deferred to match the cash flow timeline. This is the correct answer. This is the exact idea of moratorium, especially for long gestation period and delay the profit until profit coming. This is completely incorrect. So the correct answer is option C. So what is moratorium? Moratorium is basically the grace period, right? Moratorium, it is basically a grace period, not a loan holiday, right? And it is mostly used in project finance where cash flow start later. So principal is deferred. Remember, principal payment is deferred. Interest is usually payable. Interest is not deferred. Interest is usually payable unless agreed otherwise, right? So in some agreement it may be possible that interest is deferred, but in most of the cases principal is deferred unless agreed otherwise, right? It is not a default, it is a part of the original plan, right? So remember, principal is deferred to match the cash flow timeline. That is the point. That is all about the moratorium. I hope that makes sense to you. Now, friends, let's see the next question that we have. So this is again a numerical based question. Let's try to solve this one. Let's try to break it down. So question is, as you can see, PQR Limited, right? So what is happening at the PQR Limited, a steel manufacturing company? Total revenue 150 crore, variable cost 90 crore, fixed operating expense excluding depreciation is 20 crore, depreciation and amortization is 5 crore, interest on term loan is 6 crore, and interest on working capital loan is 2 crore. The company is seeking additional funding and the bank want to assess whether PQR is in position to handle more interest obligation. So the question is, that means can they pay interest comfortably? So basically the question is, what is the interest coverage ratio for PQR? This question is most frequently asked. What is interest coverage ratio? Right. So the question is asking, okay, no connectivity. Okay, fine. Please let me know, am I audible to you? Is the slide clear? Please let me know. I think there was connectivity issue in between, right? So please let me know if everything is okay. Is everything okay on your side? Is voice and audio or slides are okay or visible to you? Okay, fine, clear. Now, friends, let's come back to this question. See what is happening in this case. Let me explain. So imagine that you earn rupees 1 lakh per month. Suppose you earn rupees 1 lakh per month, right? And you pay 20,000 for food, right? You pay 15,000 for rent. You pay 10,000 for transport, right? And then you still need to pay EMI of 20,000. You pay EMI of 20,000. So before taking more loan, would not the bank ask that how easily can this person pay their EMI with the current income? That is exactly what ICR tells us. Interest coverage ratio tells us. See, this is a classic example to understand this ICR, interest coverage ratio. Again listen to my example. Suppose you earn a 1 lakh rupees per month and you spend 20,000 on food, 15,000 on rent, 10,000 on transport, and 20,000 EMI you have to pay. Now suppose you want to take more loan. So before taking more loan, bank will ask you how easily can this person pay their EMI with the current income. And that is exactly what ICR is. That is called interest coverage ratio. You know what is the formula for ICR? The formula for ICR is very simple. If you know the formula, you can answer this question very easily, right? Interest coverage ratio. See, the formula for ICR is, let me write it down, right? You must also know it because question is asked based on ICR, right? The formula for ICR is EBIT upon interest expense. EBIT upon interest expense, right? It tells us how many times a company can pay it interest using its profit from the operation. Try to understand. Try to understand what is happening. So this EBIT means what? That the profit that the company generate. And interest expense means what? How many times company can pay it interest using the profit from its operation. That is what this ICR tells us, right? How many times a company can pay it interest using its profit from the operation, right? So how we have to calculate here EBIT? How to calculate EBIT? Can anyone calculate EBIT for me? Please do the calculation. Please tell me, is the formula clear? It tells us how many times a company can pay it interest using profit from its operation. EBIT is what? Profit from its operation in perspective of a company. So can you calculate EBIT? How to calculate the EBIT? Please let me know. It is very simple, right? Let me explain how to calculate the EBIT. Again, I will use that particular pie chart example. Pie chart example is the easiest way to calculate all this kind of thing. So let me again show you how to calculate. So you draw this pie chart, right? So total revenue is 150 crore. Just write here 150, right? And you draw a line like this. So this is your variable cost 90 crore, right? So the remaining is how much? 50 minus 90, and one part of this will be what? One part of this will be our fixed cost, right? One part of this will be our depreciation, and the remaining thing will be our EBIT, right? So how much is the fixed cost? So fixed cost is fixed cost is given 20 crore. How much is the depreciation? Depreciation and amortization is how much? 5 crore, right? So can you tell me what is the EBIT? So just see this particular pie chart, right? And you can easily calculate the EBIT. I'm waiting for your response. Please do the calculation. So out of 150, if you subtract 90, what you will get? See, it is very simple. It is very simple to calculate, it is very simple to calculate this EBIT. Let me explain how to do that. See, 150 minus 90, this will become, 60. Further subtract 20, further subtract 5. So this will be how much? This will be, please tell me, is it clear or not? This pie chart example is the best way to calculate EBIT. So 150 minus 90 minus 20 minus 5. So how much you will get? You will get 35 crore. Please tell me, is it clear or not? So this EBIT you get 35 crore, right? And so this is your EBIT. So what is the formula for interest coverage ratio? EBIT upon interest expense. EBIT upon interest expense. How much is the interest expense? Tell me, how much is the interest expense? Yes, very good. 35 crore. Very good. 35 crore. 35 crore is, 35 crore is the EBIT. Very good. Right. So always use this pie chart. This will give you a calculation. Very good. Now friends, can you tell me how much is your interest expense? Please type. I am waiting for your response. How much is the interest expense? So see, two interest they are paying, 6 crore and 2 crore. So the interest expense is how much? 8 crore. Now can you tell me what is the final answer? Can you tell me what is the interest coverage ratio? Yes, they are paying interest on term loan and the company is also paying interest on working capital loan. So how much is the total interest they are paying? Total interest they are paying is 8 crore, right? And how much is the EBIT? EBIT is how much? 35 crore. So now can you tell me what is the interest coverage ratio? Just divide both of them. Just divide both of them. So in the numerator I will write 35 crore, in the denominator I will write 8 crore. So how much you are getting? So I think I'm getting 4.375 times, right? So option number C is the correct answer. So what does it mean? It means that PQR Limited earn enough from its business to pay it interest 4.357 times. That is actually a strong position. It tells the bank that we are financially healthy. Even if the profit drop, we can still pay the interest, right? And this is what bank assess before giving the loan. Please tell me, is the concept clear regarding this interest coverage ratio? How to go about solving a problem based on interest coverage ratio? Right. I hope it is clear now. Right. Now, suppose ICR is less than 1. Suppose ICR is less than 1, right? What would that mean? Is it a good thing or is it a bad thing? Will bank give the loan or will not bank not give the loan? Type yes if bank give the loan, type no if the bank will not give the further loan. Suppose ICR is less than 1. What will happen? Type yes if you think that bank will extend further loan and type no if bank will not extend further loan. ICR, interest coverage ratio, right? Just waiting for your response. So basically, if we talk about the ICR, let me just revise what we have discussed. So this EBIT tells us how much a company earned before paying interest and tax. Before paying interest and tax, how much it earned. And interest coverage ratio means EBIT upon interest. So if ICR is less than 1, what does it mean? So it means obviously no. Yes, very good. It means bank will not extend the loan. Why? Because the position is not good for for that particular company. Right, right. That is the point. So higher ICR, it is higher ICR. It means safe for the banker, safe for the bank, and lower ICR means risky borrower. Right. Very good. I hope the concept is clear now. Right. I hope the concept is clear. What is the significance of ICR? We can understand easily using this example. Now come back to this particular question. Let's come back to this question. Friend, what is happening here? This ABC Limited, they have issued debenture, right? So what is happening here? That is ABC Limited has issued debenture 3 years ago, right? With these terms. So tenor is 7 year, call option after 3 year at the rate 105 per debenture, put option over 5 year at the rate 110 rupees per debenture, right? Now, what is happening? Convertible into equity after 6 years in the ratio 1:10, right? So please read this question carefully because I am going to ask you a question based on them. Again, I am repeating what is happening. ABC Limited issued a series of debenture 3 years ago with the following feature. Tenor was 7 year. Call option after 3 year at the rate 105 per debenture and put option after 5 year at the rate 110 per debenture. And this debenture can be converted into equity after 6 year at a ratio of 1:1. That is one debenture means 10 equity share. Now let's come to the question. What is happening here? That now after 3 years, interest rate in the market have fallen. The prevailing interest rate have dropped, right? Below the rate on this debenture. So the market interest rate has fallen below the coupon rate on the debenture, right? So if the interest rate drop in the market, is it good or bad for the company? Tell me. Type good or type bad? What do you think? So please understand what is happening in the question. Please, I request you. See what is happening. That this company has issued a series of debenture 3 years ago, and the tenor is given, call option, put option. They have exercised. They have taken for hedging purpose, and they have they can convert this debenture into equity after 6 years. But what happened? That what happened just after 3 years. Remember, just after 3 years, what happened? That interest rate in the market have fallen, right? And below the rate below the rate on this debenture, you can see the rate on this debenture, right? Interest rate in the market have fallen. So the interest rate drop in the market, is it good or bad for the company that are paying higher interest? Type good or type bad? What do you think? So Type good or type bad? What do you think? Suppose interest rate drop in the market, is it good or bad? So let me explain what is happening. Suppose you are paying rupees 1000 EMI. Let try to understand what is happening. You are paying rupees 1000 EMI every month on an old loan. You are paying 1000 rupees as EMI on an old loan every month. But now bank are giving loan at lower interest, and your EMI could drop to rupees 800 if you take a new loan. So what would you do? Close the old loan early, or option A, what would you do? Close the old loan. Option B, obviously you will close the old loan, right? And you will take a new cheap loan. You will take a new cheap loan, because in earlier loan you have to pay rupees 1000 as EMI. In the new loan you will have just to pay rupees 800 in the EMI. That is exactly what is happening, what ABC Limited is thinking with this debenture, right? So let's see what are the options. So which of the following strategic action can the company take based on the embedded feature in the debenture? Option A, exercise the put option and force investor to redeem early. Option B, exercise the call option and redeem the debenture early as per agreed price. Option C, convert all debenture into equity immediately to avoid further interest payment. Option D, issue voting right to debenture holder to get approval for early repayment. See what happened, that prevailing interest rate in the market have dropped below the coupon rate of its outstanding debenture. Because you know what is debenture? Yes, obviously it is a bad thing. Yes, it is a bad thing for the company. Very good. You know what is a debenture? Just like it behave like a bond, right? What is happening, that is the coupon rate is higher than the prevailing interest rate, right? So what banks should do? Sorry, what this company should do? That is the point. So option A is saying call option. You know call option, put option. If you know this call option, put option, then only you can answer it, right? So if you know it, the call option, put option, then only you can answer it. So let's understand the option in this debenture. So call option they can exercise after 3 years. You can see it is written, they can exercise the call option after 3 years. What does it mean? It means that the company can call back, right? Company can call back or redeem the debenture before maturity by paying rupees 105 per debenture, right? That is called company can call back. The company can call back or redeeming, either you call it call back or you call it redeem. The company can redeem the debenture before maturity by paying rupees 105 per debenture. And if you talk about the put option, this means investor can force the company to redeem at 110 per debenture. Remember, this put option is available to the investor, and this call option is available to the company. So in under put option, investor can force the company to redeem at 110. And the third option, it have to convert into equity. This means holder can convert debenture into share later at a pre-decided ratio. But what is happening is that interest rate have dropped. So what should company do? So the correct answer to this question is option number B, right? Why? Because interest rate are low in the market. So the company can redeem debenture early using the call option at rupees 105, and they can save on the high interest cost, right? And they can reissue the new debenture at lower rate, right? Since the market rate is lower and company is paying higher to the debenture holder, so what it will do, it will exercise the call option, it will redeem all the debenture, it will pay at rupees 105 per debenture, right? And they will reissue, right? You know call option, put option. Please tell me if it is not clear, then I will explain. Option B is the correct answer, right? That it will exercise the call option. You know what is call option? We have discussed in BFM. You know call option means what? Call option means the issuer right to take back early. Those who have issued the option, they have the right to take back early. They can call back. They can call back early, right? They take back early. That is the issuer right to take back early. Then what is put option? Put option means what? Investor right to return it early, right? Suppose investor decided that no, I want my money back. I want my money back. Take your debenture and give me money. That is called put option. And company said to investor, okay, what I am doing, that whatever debenture I have given you, I'm returning the money and give back my debenture, right? So that is the call option. And convertible debenture, you know what is happening? That debenture is converted into equity, that becomes share later, right? Why the company will use call option? Because to avoid paying higher interest when cheaper fund are available. Suppose coupon rate is suppose 8%, right? Coupon rate is 8% and prevailing market rate is only 6%. So why companies at loss? Why you don't think that companies at loss? Because company is paying 8% coupon to the debenture holder while the market rate is just 6%. So what company will do? It will exercise the call option. it will say to the debenture holder that, I am repaying you, I am redeeming the debenture, I am repaying you, right? And I will repay all the debenture at the rate of 105 rupees, and I will reissue the new debenture at 6% interest rate, which is the market rate, right? So this is the what company will do. Okay, I'm explaining again, right? See what is happening. See, market rate is 6%. I'm taking an example. Suppose market rate is 6% and company debenture rate is 8%, right? So company is at loss because company is paying 8% coupon rate to its debenture holder. So what it decided? They decided to exercise the call option. By exercising the call option, what will happen? That this company, right? So this is the company, right? And these are the holder. What the company will do? This will give the holder the money at rupees 105 per debenture, right? And it will reissue those debenture at 6% interest rate, right? So the company can save a lot of money. Please tell me, is it clear or not, right? So one thing I want to ask you, that who hold the call option? Who hold the call option? Option A, investor. Option B, the company. What do you think? Who hold the call option? Please answer. Right. So this is a very important thing. Question are asked that call option is held by whom? Is it investor hold the call option, or is it the company who hold the call option? Right. The answer is, option B, company. Company can call back the debenture. It can redeem the debenture. My second question is, if the interest rate rise in the market, will the company still use the call option? What do you think? Yes or no? Suppose interest rate rise in the market. Here interest rate decrease. Suppose interest rate rise in the market. Will the company use call option? Yes or no? Will company use call option? Suppose interest rate rise in the market. Will company exercise the call option? What do you think? Yes or no? Obviously no. Why it will use? Because interest rate rise in the market, it will have to pay more interest to the debenture holder. It is paying, suppose, try to understand. This is the logic. Suppose debenture coupon rate is suppose 6% and market interest rate is 8%. So company will, why will exercise call option? Not exercise the call option because it is paying 6%, which is the beneficial for the company. So remember what we learned from this question is that debenture with embedded future. So these are called debenture with embedded future. Remember, debenture with embedded future give flexibility, right? If the market conditions are right, company can call back the old higher interest rate instrument. They can save the cost and they can issue newer one at lower rate. Please, if this concept is not crystal clear, please type clear in the chat box. This is very important concept. Based on this question was asked, right? Based on this concept, question was asked that when will company will exercise call option, when will investor will exercise the put option. Sometimes investor can exercise put option also, right? So this concept, now you see the investor case, right? Now one thing we have discussed about the call option which is exercised by the company. Now let's see what investor can do. Let's see this particular question. So ABC Limited issues debenture with this feature, right? Again I told you 7-year maturity, right? Call option after 5 year and put option, call option after 3 year and put option after 5 year. Now imagine you are an investor. Suppose you are an investor. It has been 5 year and you need cash urgently, maybe for a family emergency or a new home or a big wedding. So what you can do? Obviously. So question is, suppose an investor debenture want to exit after 5 year due to personal liquidity issue. Which of the following right or feature can the investor rely upon? Force ABC Limited to convert the debenture to equity immediately. Demand early redemption using the put option. Sell debenture back to the company and under the call option clause. Use voting right at debenture holder to demand early exit. What do you think? Very good. So now answer this question. So if you need money urgently, would you rather sell your debenture to someone else or ask the company to return your money using a legal clause, right? So basically, debenture are like loan you give to a company. Now you want your money back, right? Thankfully. So what do you think? I hope this is clear. Then you can answer this question easily, right? So what are the option? Option is saying force conversion to equity. So equity conversion is allowed after 6 year only. You see clearly written that conversion to equity, it can happen after 6 year. Clearly written after 6 year, right? So you can't convert into equity after just before the 6 year, right? Option B, put option. Yes, this is what they will use. Put option. Put option. So that is the correct move. right? So debenture are like, loan, right, that you give to the company, right? Now you want your money back. So ABC Limited has given a put option. It's like saying, hey investor, if after 5 years you want to leave, no problem, just ask us to buy it back at rupees 110 per debenture, right? So that is what company is saying to ABC. That is what company is saying to the investor, if you want money after 5 years, no problem, right? Just ask us to buy it back at rupees 110 per debenture. So it is your right as the investor. The company can't say no. That is what we call put option, a pre-agreed exit option for the investor, right? So I hope it is clear now. Please tell me option B is the correct. So what we learned from this discussion is that, call option means, it is the company right. Remember, call option is the right of company, and put option. So put option is the investor right. Put option, is the investor right to get out early, and conversion happen after the timeline. And what is the voting right? You know what is the voting right? So voting right means what? It come after you become a shareholder. Once you become shareholder, in debenture is not a share. Once you become shareholder, then only voting right will come post conversion, right? So please tell me, do debenture holder have voting right before conversion? Please answer. Do debenture holder do debenture holder have voting right before conversion? Yes or no? Do debenture holder have voting right before conversion? Yes or no? What do you think? Just answer it fastly, right? Do debenture holder have voting right before conversion? You know what is voting right? So you can vote, you can have a say in the company decision. That is called voting right, right? So do debenture holder have voting right before conversion? The answer is no, right? Obviously no, right? So I hope it is clear. The concept is clear, right? Main thing is what, conceptual clearance. Once your concept is clear, you can answer any question, right? Very good. Now let's see this particular question. Again a numerical one, right? Again a numerical one. Let's try to answer this question. Let's try to answer it. So the question is, as you can see on your screen, friends, XYZ company has provided this data for the year ending 31st March. Now, sales is given, how much? 84 lakh, right? P by V ratio is given, profit by volume ratio is given 27.55%. Fixed cost excluding interest is 6.96 lakh, and 12% bond 37 lakh. Face value is 1000. Equity capital equity capital is 50 lakh. Tax rate is 40%. Right. Tax rate is 40%. So these are the data which is given. Right. So, no, sir, I'm not getting. Concept is not clear. Please tell me. I will again explain. Please tell me whether the previous question concept is clear or not. Put option and call option. Company will exercise the call option, and investor will exercise the put option. That is the basic point, right? And the third option available is conversion to equity. That, debenture can be converted into equity, right? And that is the third option, which can and after you have converted debenture into equity, then only you will get the voting right. That means you have the right to vote, right? Now come back to this question. I will again explain the previous question again. Now listen to this question carefully. This is a very important numerical question, right? So the question is asking you, the data have been given. The question is asking you to calculate the EBIT. You have to calculate the EBIT, right? You know how to calculate the EBIT? You know what is EBIT? Earning before interest and tax. So it is the profit from the regular operation before the company pay interest on the loan and before the tax are deducted, right? So if a company sells a product, earn revenue, subtract all its operating costs like salary, rent, electricity, what is left is EBIT. See what is happening. Suppose company had sold a product. After selling, right? Obviously this will earn revenue. After selling, the company will earn revenue, and from revenue it subtracted all its operating costs, right? Like salary, rent, electricity. What is left is EBIT. You know it very well, right? So how to calculate the EBIT? Just now you remember the pie chart. I told you the pie chart is the most effective way to calculate EBIT. But before that, you must know contribution. How to calculate the contribution? So to calculate the contribution, you will use this profit volume ratio as well as sales, right? So basically, what is contribution? Again, I am drawing this pie chart. This is your total sales. After you have deducted the variable cost, what is remaining is called contribution, right? So contribution is the portion of the sale that is left after variable costs are deducted. So it is the money. This contribution consists of two things: the fixed cost and the profit. So it is the money available to cover the fixed cost and profit, right? So how to calculate the contribution here? So profit by volume ratio is given and sales is given. So what you do, there is a formula which you can use to calculate the contribution. Can anyone calculate contribution for me? What is the contribution in this case? Okay, no connectivity. Okay, again there is issue. So friends, welcome back to the session. I hope everything is okay right now. Now friends, we have to calculate the contribution first. So how to go about calculating the contribution? So the formula is simple. To calculate the contribution, what we need to do? We need to multiply the sale. We need to multiply the sale by P by V ratio. Just multiply the sale by this P by V ratio, right? This formula you have to remember, this profit by volume ratio. If you multiply by the sale, right? I hope everything is okay. I hope everything is okay. I think there was some connectivity issue, right? So just multiply this sale by PV ratio. How much you are getting as contribution? Please let me know, right? So sales is how much? 84 lakh. 84 lakh is your sales. And what is your P by V? P by V is 27.55%. So how much is 27.55% of 84? Actually, it is 84 lakh, right? Not 84. 84 lakh, right? 27.55%. So how much it is? Please do using calculator, right? Please calculate how much you are getting. 27.55% of 84 lakh. This P by V ratio, profit by volume ratio. So, P by V ratio, what it means, it tells us the profitability of each rupee of sale, right? It tells us profitability of each rupee of sale. Means, for 1 rupee you are selling, how much profit you are getting. That is what this P by V tells you. And, if you multiply the P by V by sale, this will give you the contribution, right? So, volume per profit per unit volume. This means if you are selling 1 unit, how much profit you are generating, right? That is what this P by V ratio is. So if you calculate this 27.55%, you will get 23 lakh 14,200. Please let me know. Are you getting the same? Yes, very good. 23 lakh 14,200. Very good. Now we know the contribution. Now can you calculate the EBIT? Can you calculate the EBIT? How to calculate the EBIT? Again, draw this pie chart. Right. Again, draw this pie chart. This will be super helpful to understand EBIT. Right. So your sales is how much? Your sales is 84 lakh. Your variable cost is how much? Your variable cost, okay, variable cost is not given. Contribution is how much? So this portion, contribution is how much? 23 lakh 14,200, right? 23 lakh 14,200. And this contribution consists of some fixed cost, right? This contribution consists of some fixed cost, and the remaining portion which is left is called EBIT, right? EBIT. So how much is the fixed cost? Fixed cost is 6.96 lakh. 6.96 lakh. So what will our EBIT? What will be our EBIT? EBIT will be how much? It is very simple. 23 lakh 14,200 minus 6 lakh 96,000. Please do the subtraction. How much you are getting? Please do the subtraction. Please tell me, is it clear? Contribution consists of two things. One thing is profit, other thing is fixed cost. Remember it. Remember this diagram. This pie chart is super important, right? So we have just calculated the contribution. This profit by volume ratio tells you for 1 unit of the sale, how much you are generating profit. That is called profit by volume ratio. So if you subtract both of them, so options as you can see, which option is correct? 11, 7, 4, 200, right? And so I think I am getting 1618200, right? 16 lakh 18,200. Are you getting the same? Yes, very good. B is the correct answer. 16 lakh 18,200. That is how we get the answer. So let me summarize the fact, what we learned from this question, right? What we learned from this question, this P by V ratio, it tells us profitability of each rupee of sale. And one formula you must keep in your mind, that contribution is multiplication of sale and the profit by volume ratio, and EBIT is equal to contribution minus fixed cost, right? So remember, interest and taxes are handled after EBIT, right? So in this case, as you can see, depreciation calculation has not been included, right? Depreciation calculation has not been included in the EBIT, right? Now let's come back to this particular question. Now again, in the same question, this is the second part of the above question, right? We EBIT, right? And interest on the bond is interest on the bond, you have to calculate the DFL, degree of financial leverage, and options are 1, 1.38, 0.73 and 2. So come back to this question, you have to calculate the degree of financial leverage. We have talked about the degree of financial leverage in the first part of the question. EBIT you have just calculated. It is how much? EBIT is how much? We have just calculated 16,18,200. This is our EBIT. And now you have to calculate DFL. What is the formula for DFL? You remember? Degree of financial leverage formula, right? We have just talked about degree of financial leverage formula. You remember what is the formula for DFL? It is nothing but EBIT upon EBT, right? So basically EBIT upon EBT. So how to calculate EBT? You know how to calculate EBT? It is very simple. From EBIT you subtract the interest. See, EBIT. See how to calculate EBT? Very simple. You remove this I. You remove this I. This will become EBT. And what is this I? I is interest. So you subtract the interest, you will get EBT. This way you can remember. And how much is the interest? How much is the interest? You can see interest is 12% bond. Face value is 1,000. And the 37 lakh, right? 37 lakh. How much is the interest? Can you calculate the interest? See, basically bond coupon rate is given how much? 12%. Face value is how much? 1,000 rupees is. Basically, bond are issued they have the face value, and 37 lakh. So can you calculate the interest? It is very simple. You calculate 12% of this 37 lakh, isn't it? So if you calculate the 12% of 37 lakh, what will be the answer? Please calculate the interest. So 12 by 100 multiplied by 37 lakh. How much you are getting? Please let me know. Just waiting for your response. 12% of 37 lakh. What will that value will be? So it will be 4 lakh 44,000. Right. That is our interest. So now if you want to calculate EBT, that is earning before tax, which is equal to EBIT minus interest. So what is EBIT? We have just calculated, it is 16,18,200. 16,18,200 minus interest. How much is the interest? 4,44,000. Just subtract it. How much you are getting? 11,74,200. This is our EBT. Please tell me, is it clear? Is it clear till now how we have calculated EBT? Now let's come back to this question. We have to calculate the DFL, right? Options. So now we have calculated EBT. EBT is how much? 11,74,200. And what is EBIT? EBIT we have calculated as 16,18,200. What is our DFL? DFL is the ratio of EBIT upon EBT. So what will that will be? So it will be 16,18,200 divided by 11,74,200. So what value are you getting? Please tell me. Yes, 11,74,200. Very good. That is our EBT. Very good. And now just divide both of them. So after division, it will be near about 1.38. Just now I have calculated. It is near about 1.38. Do you know what is the meaning of this financial leverage? Let me explain. Let me explain a little bit. Suppose a company is doing well and earning good profit, but instead of using it on money, it borrow some to grow faster through bond or through loan. Listen to my word carefully. You will be easily able to understand the financial leverage concept. This is very, very important. Okay. Everyone facing the connection issue? Because on my side everything is okay, right? Please tell me, is connection issue everyone is facing this issue? connection issue? Please let me know. Because I have opened another live session and it is working perfectly. Because most frequently I'm seeing, okay, no, I think there is some network issue, right? Everything is okay, fine. Okay, now friends, listen to my word carefully, that what is financial leverage all about. See, imagine a company is doing well and earning good profit, but instead of using it on money, it borrows some to grow faster through bond and loan. Now it must pay interest, right? It must pay interest on that borrowed money. So if the company earn well, suppose the company earn well, right? Profit are great. Obviously, the profit are great if it is earn well. But if the earning drop even a little, that fixed interest cost still has to be paid, isn't it? Suppose company don't earn well, this interest the company has to pay, no matter whether it is earning good or earning bad, right? That is where financial leverage comes in. The more borrowed money you use, the more your profits swing up or down due to fixed interest, right? That is what, the more borrowed money you use, the more your profit will swing up or it will go down due to the fixed interest, because interest is fixed no matter the company is earning great, right? See, what I'm talking about, the financial leverage. What is the meaning of financial leverage? Means the more borrowed money the company use, the more your profit will swing up and down due to the fixed interest part, right? So that is how. So answer to this question is 1.38, right? And one thing you must note it down, that if DFL is greater than 1, right? So one thing you must note it down, that if DFL is greater than 1, it means, company is using the financial leverage and earning are more sensitive to the change in operating profit, right? This means company does have some debt. So 1.38 means what? It means company also does have some debt, right? But it's not too higher. The earning before tax are moderately affected by interest cost. So in simple word, company is using borrowed money, which is helping a bit, but there is some risk involved, right? So one thing I want to tell you, this is very, very important thing. Please remember, see, DFL, degree of financial leverage. It tells us how much the interest cost magnify the profit change. It tells us how much the interest cost magnify the profit change. If it is greater than 1, it means there is a financial leverage. If it is greater than 1, it means there is a financial leverage. And if DFL is higher, it means risk is also higher and reward is also higher. Risk is also higher, reward is also higher. And this 1.38, this is a moderate DFL. This is a moderate DFL. It's called balance. It's called balance. But still risky if earning fall, right? So that is the point. Now, friends, let's look at this particular question. Very good question, right? Let's try to answer it. So, as you can see, we have two scenarios for company. In scenario number one, EBIT is 1 lakh, tax is 50 lakh, 50,000, profit after tax is 50,000, number of share is 10,000, EPS is 5. In scenario number two, EBIT is 1.5 lakh, tax is 75,000, profit after tax is 75,000, number of share is 10,000, EPS is 7.5. So the uh, question is what is the DFL in this case? So the scenario is for a firm. So what is the DFL in this case? What is the degree of financial leverage in this case? Right. So one thing you can see, right? So you know the formula for DFL? Just now I told you EBIT upon EBT. That is one formula. There is another formula for DFL, right? And there is another formula for calculating the DFL. You know what is that? So DFL tells us how the EPS, which is called earning per share, changes when EBIT, when our operating profit change, right? Try to understand. This is another way to understand the DFL. One formula I already told you, which is EBIT upon EBT. This is another formula, that is percentage change in EPS upon percentage change in EBIT. This is another formula for DFL. It tells us how much the EPS change when EBIT change, right? So if your business has, try to understand this, very, very important. Suppose business has no loan, right? Suppose a business have no loan and business have no interest to pay. Suppose business has not taken any loan and has no interest to pay. What will happen? Any change in EBIT, delta, delta means change. This is a sign of change. Any change in EBIT will directly reflect in change in EPS, right? So because no interest company has to pay, no financial pressure, in that case DFL will be 1. in that case DFL will be 1. But if the company has to pay interest, even a small change in EBIT would lead to bigger change in EPS. That is called leverage. Now, can you calculate DFL in this case? The formula I have written simple here: percentage change in EPS upon percentage change in EBIT. Please do the calculation. Two scenarios have been given, right? So as you can see, look at this EPS and look at this EBIT. Look at these two column, right? So earlier EPS was 5, now it increased to 7.5. So how much is the percentage change in EPS? So you know how to calculate percentage change: final value minus initial value upon initial value multiplied by 100. So this will give you percentage change in EPS. How much it is? This is nothing but 2.5 upon 5 into 100. So almost it is 50%. It is 50%. How much is the percentage change in EBIT? You can see earlier it was 1 lakh, later it become 1.5 lakh. So 1.5 lakh minus 1 lakh upon 1 lakh multiplied by 100. How much it is? It is also 50%. Now can you tell me how much is the DFL? Please let me know. How much is the DFL? I am waiting for your response. How much is the DFL? Just apply the formula. Right. Just apply the formula. Percentage change in EPS upon percentage change in EBIT. That is what DFL is. Right. Right. Yes, option B is the correct answer. It will be equal to 1. Very good. It will be equal to 1. Right. So why it is 1? You know why it is 1? Because both are moving in the same way. Right. Because EBIT is growing by 50%, EPS is also growing by 50%. Right. So no interest, no financial leverage, DFL is 1. That is the point. Right. So there are no fixed interest cost. Why it is 1? There is no interest. You see any interest component here? There is no interest cost. And whenever there no interest is there, no financial leverage is there, you need not calculate anything. No need to calculate anything. You can see clearly written here. आप यहाँ पे देखिए. Please see here. Clearly written in the question. The firm has no fixed interest charge. Whenever you see this line, no fixed interest charge, it should strike your mind that no interest the company has to pay. And when no interest it has to pay, it has not taken any loan, it has not taken any bond. That means what? That means, it simply means that it DFL is equal to 1. No need to calculate anything. Remember it? I hope the meaning of DFL is equal to 1 is clear. Please type clear in the chat box if it is clear. No need to calculate anything, right? If you see this word written, no fixed interest charge, it simply means DFL is equal to 1, right? Please let me know if it is clear or not. Now friends, let's look at the second question. Now the same scenario, but here is interest involved. Now you see another column for interest here, right? Now you see another column for interest. This is the very good question, right? So in the scenario number 1, you can see EBIT is given, interest is given, EBT is given, tax is given, PAT is given, number of share, and EPS is given. Similarly in the scenario number 2, right? Now the question is, what is DFL and what does it indicate, right? Very good. It is clear. Now let's try this question. Now we have interest component also, right? How to find the DFL in this case? How to go about finding the DFL? So in this case, interest is there, means business is borrowing money, and when a business borrow money, it pay fixed interest, whether profit are high or profit is low, no matter. So imagine you earn more, that means your EBIT increase. So after paying the same fixed interest, your remaining profit increases faster. That is called the leverage, right? So again, we have to apply the same formula for calculating the DFL. So what is the percentage change in EPS? I want everyone to calculate it. It is nothing but 6.5 minus 4 upon 4, right? So how much it is? It is near about 62.5%. And what is percentage change in EBIT? Just use this data. Again, it is 1.5 lakh minus 1 lakh upon 1 lakh. How much it is? I think it is 50%, right? So how much is your DFL? So your DFL is 62.5 divided by 50%. So how much it is? Near about 1.25%, right? So 1.25 means option number A, right? So what is the meaning of this 1.25? You understand? What is the meaning of this 1.25? See, it means that EPS is 25% more sensitive than EBIT. See, EPS upon EBIT. So this 1.25 means that EPS is 1.25 times more sensitive than EBIT. So it means that if your EBIT, try to understand this, very, very important. If your EBIT increased by 10%, if your EBIT increased by 10%, right? EPS will increase by 12.5%. In plain English, it means why? Because of that fixed interest rate, creating leverage. You have taken a loan, and that is creating a leverage, and because of that leverage, your EPS is increasing by 12.5%. So the correct answer to this question is option number A, right? So no interest means DFL is equal to 1. Fixed interest, it might be greater than 1 or it might be less than 1, right? I hope it is clear now. I hope it is clear. Please tell me. Now let's see the third part of this question. A firm is operating at the financial break-even point. What will be the DFL? Very good question, right? You know the meaning of break-even? You understand the meaning of break-even? Suppose a firm is operating at the financial break-even. What will be the DFL? Degree of financial leverage. So, financial break-even point means what? It means, no profit is there, no loss is there, right? Again, I come back to this particular diagram. This is your sale, this is your variable cost, right? And what happened at the break-even point? This contribution is of two part. One part is the fixed cost, other part is your profit or your EBIT. But whether you call it profit or you call it EBIT, both means the same. You know what happened in the case of break-even? Break-even means you have no profit. Your no profit is zero, right? Since your profit is zero, that means EBIT is equal to zero, right? So that in that case, what will happen? Your contribution will be equal to fixed cost, right? So EBIT will be zero, the company operating profit. So what is here, the point is, financial break even. What is the meaning of this financial break even? It means, it means the company operating profit, that is EBIT, is exactly equal to the interest cost, is exactly equal to the interest cost, right? So suppose EBIT is 20,000, suppose EBIT is 20,000, so interest cost is also 20,000. Means whatever your profit is there, same is the cost, right? So there is nothing left for the shareholder. For shareholder, there is nothing left, right? Suppose your EBIT, earning before interest and tax, is, see, try to understand this. This is very, very important. So your EBIT, earning before interest and tax, is how much? 20,000. And your interest cost is how much? 20,000. Can you tell me what will be EBT? I am waiting for your response. What will be EBT? Your earning before interest and tax is 20,000. Your interest cost is 20,000. What will be the EBT? Please answer. Obviously, it will be zero. Very good. It will be zero because, we subtract EBIT and interest, then we will get EBT. It will be zero. So your EBT is zero. Since your EBT is zero, it means tax, nothing tax is zero, right? PAT is zero, profit after tax is zero. Your EPS is zero, earning per share is zero. Everything is zero. And what is the formula for DFL? What is the formula for DFL? I told you now. The formula for DFL, is percentage change in EPS, right? And upon percentage change in EPS upon percentage change in EBIT. That is what the formula for DFL. So if EPS is zero, right? EPS is zero, so this DFL become undefined because it is in denominator. EPS is the denominator, so DFL become what? Undefined. It is become undefined. So at financial break even point, DFL become undefined. So option D is the correct answer, right? So option D is the correct answer, right? Very good. So let me explain what is happening here. That suppose you run a chai shop. Try to understand using a live example. Suppose you run a chai shop, right? Your rent is rupees 5,000. Suppose you sell enough chai to earn rupees 5,000, right? So what is your profit? Your profit is zero. Now your uncle asks you, how much more profit will you make if you sell 10 more cup? You will say, I don't know yet, because right now you are just breaking even. That is what DFL is like here. You can't calculate it as break even, right? So I hope it is clear. At break even, what is the DFL? It is undefined, right? So remember, at break even, what happened? At break even, your EBIT will become equal to the interest, right? And at BBI and at break even, EBT will become equal to zero. At break even, PAT will become equal to zero. At break even, EPS will become equal to zero, right? And therefore, DFL become what? Undefined. DFL become what? Undefined. Tell me, is it clear? Is it clear? What is the this question is most frequently asked regarding if you understand break even clearly or not, or you want me to repeat it again? Please let me know. So break even means what? You have no profit is there. right? So your earning is equal to the interest cost. Total earning is equal to cost, right? EBIT means in interest, and ultimately EBT become zero, PAT become zero, EPS become zero, and TFL become undefined, right? So friends, today let's end here. Like today, wrap up the session here. We will continue. We have more some interesting question, right? See what we are doing. We are trying to clear our concept using questions. This is the perfect way of understanding, right? If you go through the book theory, right, it will look boring, and you will not understand the implication. And using this case study type question, you can easily understand the importance of those concepts, right? So we will continue our discussion in the next session, right? We have some more interesting question for you. So I'm ending the session now. I hope if you have any doubt, post in the Telegram group. I hope all of you are in the Telegram group, right? And I will share the PDF there, right? And this live session, it will be recording will be available to you, right? So that's all for today.